All right. So again, good morning for today's discussion on ACCT1001, all about uh, introduction to accounting and statement of financial position. Okay. So when we introduce accounting, and you might wonder, okay, so what it is for me, okay, to learn accounting. In business, accounting is the what we call language of business. So which means they are the one interpreting information about what's happening in the business. And as business person, accountants, you need to know this. Okay. So in accounting, there are processes that mentioned there. So normally 3 plus 4. Okay. Why 4? Because that's decision making. Okay. So it says here it's a process of identifying, measuring, and communicating economic information about entity. Okay, to various users or decision making. So accounting, or in this case, introduction to accounting. Accounting, it says identifying. So they need to identify what they call, you can see that term, economic information. So accounting is primarily capturing economic information. What are those economic information? Those with monetary value. Okay, so for example, if someone sold an item, that will be recorded. So they will identify, is this transaction with economic value or information? If yes, then record. There are other events in organization that is not captured by accounting because that's not with economic value or information. I'm not saying it's not important. It means only that it cannot be captured in the financial records. Okay, so for example, if uh, someone had hired another individual, or the company hired another individual, it has monetary effect, but not yet. It will be later on. But the process itself cannot be recorded in accounting because it doesn't have that economic value. Okay? And then it says measuring. So it's not enough for you to identify, you need to measure. What it means by measure? That I mentioned about value, economic value. So it must have corresponding KINA value. Okay? And when you measure, there are different way of measuring it. Of course, initially when you purchase an item, you record it at purchase price, right? So if I purchase a laptop worth 2,000 kina, then I will record it in my own books 2,000 kina. Right there. Along the way, the value of that particular laptop may change depending on the measurement tools. Okay. Of course, for non-accountants, it may be a bit not really discussed thoroughly in your units, in other units. But what I'm trying to say is, in accounting, they use different measurements. When you say measurements, how much they will record it at the financial year end. Okay. For example, I mentioned 2,000 kina worth of laptop today. Today is March. On December, how much will it be? Will still be 2,000 kina, or we can recognize certain wear and tear or some like usage, depreciation, these things. So that is what we call measurement. Got it, huh? It will not stay the same amount. For example, land. If an individual purchases a land and then 10 years after, will it have the same value? We know the value of the land appreciates. So that is what we call measurement. Clear? And then when we measure, you need to record it and communicate. Take note, not communicate. So what does it mean? So you need to put it in a report and showing it to other individuals that may need the information to decide. Okay, if you ask for a loan to a bank will definitely will ask for your source of income, right? Or if you are running a business, they will ask where is your financial statements. So that is the one that we call communicating. We are trying to communicate the information to certain individuals. So that's the importance of accounting. So we identify transaction, we record it, we measure, put it in the report, and then communicate to others, and let others decide. That's why we have decision making. Okay? So that's actually the shortest way to explain accounting. Yeah. So is it clear? Okay. So I need to record, identify the transaction record, measure it, put it in the report, and then communicate. Okay? Because someone needs to decide. Like bank, will the bank provide you with a loan? Yes or no, based on the record. Will the investor provide additional funds? They will see, Is it profitable? Will that survive? Will the company survive for how many years? Okay, put the money. So that's another type of decision making. Okay? Okay, in identifying transaction, we have exchange of value. We call it exchange of value. That's why we have what we call double entry accounting system. If you have that in your grade 12 before, you may be familiar with what I'm talking about. The double entry transaction is where something has to be given up so that you will have something to receive. Simple, huh? Okay, for example, if I want to buy a laptop, I need to pay money. So that is something that I need to give up. And then the laptop will be acquired by me, obtained by me. Clear? So that is what we call exchange of value. Okay, clear? So if I give up something, I will receive something. It's basic business premise, right? If I sell something, I will receive money. Clear? So accounting is not really that technical, okay, scary unit, okay, let's say, oh, don't take accounting. It's not really a scary thing because we are doing it anyway. If I give something, I'm expecting something in return. Clear? It's only on the recording part that the people, do I need to record it? Tiring eh. So I need to record it manually or electronic or okay. That's where accounting will come. Okay, clear? So we are doing it in our daily lives. You coming here, paying for your school fee and listening to our lectures, and then you receiving something. Me, I'm doing my lecture. Of course, they will pay my salary. So we are doing it anyway. It's only on the recording part. That's where accounting will come. Clear? Right. So just imagine in the future, they will ask, hey, how much you purchased this item? 2 years ago? Then no one is keeping records. No one can tell now. That's where, or that is one of the importance of having accounting, the accounting process. Because accounting is the one capturing the information, putting it in file, and then saying, boss, 2 years ago you purchased this item, this is the value. Clear? Right. Now there's a concept that it says the measured and recorded, reliably measured and recorded. Now sometimes there are some information that can be estimated. Just like what I've said, you purchase a laptop 2,000 kina today, you don't know how much will it be in the future. Okay, so that is what we call reliably measured. Reliably measured is not where you just take off thought of something like, okay, I think this amount for like 100 kina. No, there should be a scientific way of knowing how much will it be. That's what we call it reliably measured. Okay. Who are the decision makers? We have two types, internal and external users. Internal users are managers, employees, okay? While external users would be banks, government, okay? Anyone who doesn't have a direct control on the information. We call them external users. Clear? So internal users, those who have a direct influence on the records, so which means that includes managers and employees. External users are those individuals or entities which will need the financial information but doesn't have a direct influence on the financial report. Clear? Easy to distinguish? Okay. Anyway, the list is there, but I'm giving that principle, the principle of determining internal and external is like that. Alright, so we'll get a sample here how they use the information. So for example, regulatory bodies. Of course, we are talking about Australian units, so they say Corporations Act and then Australian taxation law. Okay, but here in Papua New Guinea, if we talk about regulatory bodies, who will need the information? IPA, okay, and IRC, right? And also, if the entity is under a regulation like banks, they need to report also in regulatory bodies such as in banks that will be BPNG. Right, clear? So why they will use the information of the company? They will look at it if they're complying with the legislations or the regulations implemented in the country. For example, this year IRC had introduced the new Income Tax Act, right? So now, what IRC is expecting, the report that will be submitted this year for 2026 should be in compliance with the new tax code. Am I correct? So that's how they use it. BPNG, for example, if they want the banks to be more compliant on anti-money laundering act, so they will check using that. Okay, so financial information is important for these bodies. Okay, another one. Banks, we already discussed that, so we leave it. Shareholders. Shareholders are the owners of the company. Okay, so as the owner, do you need information? Why? Because you don't have time to spare, or sorry, you have lots of time to spare. Okay. No, because it's important. I'm the owner. I need to know, right? I need to know whether the company is profiting or may have problems with money, or do I need to invest additional money, or if they profited, I need my income, or we call it dividend. Okay, clear? So there are different. Sorry, there will be different needs depending on the user. Okay. Now that is why the report that you can see in the website of the company, we call it general purpose financial reports. Take note, I'm using that term. Okay, general purpose financial report, because it needs to cater the needs of various users. So you make it generic. Got it? Now we will discuss in particularly on modules 4, 5, 6. Those are what we call internal report or specialized report. So modules 4, 5, 6. But from modules 1 to 3, we will only talk about general purpose financial report. Okay. Alright, so the division of this unit particularly will be on financial accounting and management accounting. Part of management accounting. So when you talk about financial accounting, that's easy. Preparing and presenting financial report to allow decision making. And financial accounting is targeting external users. Okay, clear? External users, which means our aim in financial report, in financial accounting, if you will be a financial accountant in the future, your aim is to report not on the internal users, but your aim is to report to outside parties, shareholders, government, banks, community, and so forth. Okay? Now, management accounting is different. Management accounting is the task of that is to provide internal report, which is cannot be consumed or used by other parties, but can be used within. Okay, so don't be surprised in the future if your boss will ask you certain report, which you will say, "Boss, do we need this? We don't need to report it outside," because they need that analysis within the entity so that they can decide. Okay, clear? For example, cost benefit analysis I mentioned a while ago. So this is the amount that I spent for the product, how much I need to recover, and how much I need to sell so that I will earn profit. This is internal report. No one actually will be appreciating that report outside because it's internal. Okay? They will say, what are these items that you're talking about? And then you have to explain again and again and again. Quite difficult. Okay? Okay, I already mentioned about the difference between financial accounting and management accounting. Let's just go through some information here. So in level of detail, in financial accounting, it's quantitative and broad, which means because you're catering the needs of other users, and these users will not have a direct influence, okay, on your report, so make it generic. Okay, for example, your performance will have like in university will have P, C, D, H, D, right? So these are the grades that we use for university and even other tertiary institutions. So we know what it means by P, C, D, H, D, or pass, credit, distinction, high distinction. Even in grade 12, you have that A, B, C, D, right? So in basic education, it's clear how they will interpret that. Okay, clear? So even in accounting, we have to use those terms so that others can understand what we're trying to talk about. But in management accounting, it's more detailed and can include qualitative characteristics, which means we are not only focusing on numbers, we will also focus on certain qualitative information. Okay? Regulations, accounting needs to follow accounting standards. Simple, straightforward. But in management accounting, anything goes. Okay, why? Because again, it's customized. So it depends on what the management needs. They will say, I need the report to be like this so that I can analyze in this way. Okay? So that is a customized report. Right? So no need for regulation. Take note that you only need regulation if that will be considered as public goods. What is public goods? Anyone can consume it if you issue it outside. Is accounting considered as public goods? Yes. Why? Because if they can have that information and use it for the decision making, all of us can use it because it's available there, then we consider that as public goods. Okay, so public goods needs regulation. But report prepared inside, no need for regulation. Why? Because it's anyway, they cannot use it outside. It's only within. Okay. Users, I already mentioned. Timeliness. Financial accounting is historical, which means the transaction needs to be happen or needs to happen so that you will record. While management accounting is historical also, but more future focus, which means they will use historical information, but they will look into how it will reflect in the future. Okay, that's the difference. Now, the concept of business sustainability that we're using nowadays, okay, it refers to the world's resources in a way that does not compromise ability of future generation to meet their needs. So, businesses also needs to contribute to the sustainability. What does it mean? We're not only talking about having the resources now, but we try to save the resources now for the future generations. And as management and accountants requirement, and now it's spreading around the globe. There is a requirement now for big companies to report or provide sustainability report. What they are contributing for the environment, to the community, so or how they help the community, to of course to help the future generation. So it's part of the report for big companies. Small companies not yet, but for big companies, particularly listed companies in PNG stock exchange, they are requiring that. Big companies also have their own regulations, so they are doing the sustainability reporting. So what are those things that we need to report? All resources used, so which means not only money, that also includes labor, material, energy, forests, water, air, and what are the products that we produce. Okay, that also includes carbon emission and waste. In other countries, they implement what we call carbon tax. I'm not yet sure how they're doing it, but there is a particular formula to calculate how much carbon you consume or you emitted. Okay, and then you will be taxed based on that. Huh? What? Wait. So tax, yes, particularly developed countries, they're doing it. Okay, I'm not really sure how the formula works. I'll try to do my research so at least I can share in the future. So there's a formula, they'll calculate, so and then the government will tax. Okay, based on this emission, will tax you. That tax is used for future generation, which means they'll use the tax to develop maybe a forest or a community so that it will have that sustainability. Now, here in Papua New Guinea, we have companies who are reporting those sustainability activities. ESP, they have that Go Green thing, right? So these are part of the sustainability reporting. Oh, anyway, I wanted to go through this. It's really long. Okay, it's a principle in sustainability, business sustainability. Now, in addition, we also have to include. We have drivers of business sustainability. One is competition for resources. Now, individuals, and currently we have war in Middle East, and there will be suspicion that oil prices will go up. Okay, because that is what we call competition of resources, and that's why some of the government are trying their best to find other source of fuel, oil, and even thinking of renewable energy. Okay? Because anyway, renewable energy like solar, wind, geothermal, this is natural. So some countries are doing that. Okay? And and I've seen so many advertisements of solar powered houses, okay, or a mechanism for a house to make it solar powered. Okay? I've seen some advertisement like that here in Papua New Guinea. It's a good move, okay, because you see now we have problems in the Middle East. Some countries now have increased fuel prices, okay, even in US, okay, because of this problem, right? Climate change, this is another driver. Uh, so in Australia, it says we have a fossil fuel based economy, which means a huge part of their energy is coming from fuel. Uh, that is one of the drivers. Economic globalization, connectivity, and communication. Part of that I mentioned about sustainability reporting is corporate social responsibility, or the CSR. Take note, in reporting, managers and accountants, in reporting CSR, you're not only looking into environment. You also have to include community contribution. How you are contributing to the development of the community. Scholarship is one of those. That environmental thing, go green is another example. Okay. Other than that, what else that we can do? Aside from scholarship, we can also engage in a non-profit organization, foundation, maybe provide care, like IBS is engaged in the Cheshire. Okay, we are donating money to Cheshire. If you're familiar with that, hopefully you'll have the chance to visit, because we have our clubs, student clubs. We normally set a time for the students to visit there. Okay, it it will give you some reflection, okay, of our lives. Okay. Now, agency theory, take note. I'm really sorry, we are covering so much here. But agency theory is where the manager is the agent and the principal is the owner. Normally, the managers will have more information. Okay? Clear? They will have more information than the owner. That's a normal, because in corporate structure, it's a bit advanced now, but in corporate structure, there's a separation of power between the owner and the managers, the one running the business. Okay, so the one running the business have more information. Okay, clear? The more information. So will you believe me when I say I have more information about this class than the owner of the company of university? Yes, I have more information about you than the owner. Same thing. Okay, so in the agency theory, do you think that creates problem, or that might create problem? Yes or no? If I knew more information about this company than the owner, will I be able to do something about it or use for my advantage? Possible. I'm not saying you will do it. I'm saying there's a possibility. Okay, right? Okay. So anyway, it's not our task to discuss it now. Okay, we'll have other units to talk about it. Especially business units, you will have that. Okay, it's important for you to understand that. Stakeholder theory, we're talking about the stakeholder, which means those who are interested with the company, banks, shareholders, uh, investors. Stewardship theory, wherein directors act in their own interests. It's similar to agency theory, connected to that. Okay. Legitimacy theory also talks about how important your company in the community. Take note that company, when you talk about legitimacy theory, we're not talking about company earning profit. We're also talking about company, how important are they, or companies, how important are they in the community or in the country. Ah. Do you think universities here in Papua New Guinea is an important part of the country? So that creates legitimacy. Clear? So I'm really sorry, we don't have time to discuss this one. So. All right. Sources of regulation in Australia, we have Australian Securities and Exchange Commission. The equivalent of that one is ITA here in Papua New Guinea. Australian Securities Exchange, that the equivalent here is the PNGX. Okay, you can see in the newspaper they always publishing bid price and sell price of the shares. Australian Accounting Standards Board, we have here PNG Accounting Standards Board. Okay, FRC, Financial Reporting Council, we have also the same name. We didn't change it with the same name. And other government agencies, of course, it depends on the company. For example, university is under DHERS. Okay, so we need to comply with the DHERS regulation. Mining, Mineral Resource Authority, right? MRA. Clear? So it still depends on the regulation. Now we have different types of businesses. We have sole trader, partnership, and company. Now I'll make it really quick. We have a long PPT here given to me. Really long. Anyway, sole trader, simple. You are the owner, and also most of the time you are the manager. Take note, sole trader, you don't have that separation of entity, which means what business do is also reflecting on you. So if business earn income, you also earn income. Got it, huh? So there's no separation. If the business asset is not enough to pay debts, then the creditors will ask you, the owner, to pay for that. Okay, clear? So no separation. But you don't have any other to share your income, right? So all of you, so all the risk will be on you, but all the rewards also will be on you. Clear? Good. Easy to establish business. Sole trader. You can see outside the market there. Those are an example of sole trader. Okay, simple, easy to put up. No, not much regulation. You don't need to go to IRC to ask for tax identification number. You can put up your business. That's it. But of course, as your income grows, you need to register IRC. That's a different case. Okay. Anyway, the simplicity of forming it and operating it's there. Okay. So you can see the advantages and disadvantages. I'll leave it to you. Now, partnership definition here says association between two or more persons who carry on a business as partners and share profits. So basically, you form a partnership to earn profit. And also, you are forming a partnership for your profession. You can, sole trader can do that also, but partnership also do that. So if you share the same profession, you can build or put up your own or your partnership. So what does it mean? If I'm an accountant, there's another accountant, I can build accounting firm. Partnership. Example, PwC, EY, okay, Deloitte's, okay, and KPMG. These are examples of partnership. Okay, KTK, okay, here in Papua New Guinea is another example of partnership. Okay, law firms, if they're all lawyers, they can build their own. Okay. Now the problem is every partners will be agent of the partnership. So which means whatever one partner do will be what? Reflecting of the partnership's act or partnership's business. So if one partner asks for a loan under the name of the partnership, all of you, meaning all the partners, will be liable for that loan. So important thing in partnership is to find a reliable and trustworthy partners. Okay, or else if you cannot trust that individual, you're done. Okay, they'll use the partnership name, get the money, okay, go out of the country, maybe spend time in Switzerland if they have the billions of kina already. So, then you will be the one staying here and paying it. Okay, clear? Right. But the good thing about partnership is that because so many minds contributing in decision making and operating, then it's better, right? Two heads better than one. That's what they said. So in that case, that's also an advantage. And also, different individuals have their own resources they can put it up, operate a partnership. Problem is that's what I said. Okay? If there's a debt or loans, you need to pay. Okay? Now, company is different. Company is more structured and formal, okay, business approach. Now here, there is a separation of owners. Separate legal entity concept. What does it mean? It means that the business, or sorry, the company, I'm using the, sorry, I'm a bit technical on words. When I say company, that's we are talking about company. When I say business, most likely I'm only talking about the small business and these things. So in company, the company can ask for a loan, operate on its own, but let us say if the company asset is not enough to pay for the loan, the lenders cannot directly ask the owner or the shareholders. We call it corporate bail. Okay, so which means separate. So business affairs of the company is separate from the personal affairs of the shareholders. Shareholders are the owner. Clear? The good thing about company is that because company normally will have a huge fund to put up and more structured and formalized, and it creates legitimacy on that company, and that actually create more confidence to shareholders, sorry, to the lenders and other uh, individuals to maybe to put their money on that company. Okay. Uh, and also normally the company tax will be lower in certain bracket, lower than the individual and even partnership partners tax. Because here in Papua New Guinea, 30% for business income. Okay, sorry, net income for company. And another thing is that if you put up a company, you can claim expenses. Unlike in sole trader, if you have expenses there, you cannot shield yourself against those expenses. Okay, they will actually some of the personal expenses you cannot claim. Okay, for example, if you have a child and then you use the business money to pay for your child's uh, uh, school fee, there will be certain limit. But in company, if you are treated as an employee, company paid for that, company can claim expense. It will lower the taxable income. Okay. Anyway, when we go to the taxation, I'll teach you that some of the techniques. Okay. But then again, take note, company, it requires legal compliance, so you need to do so many paperwork. It's a disadvantage. Now, again, it depends on which structure you want. Okay? If you want a quick, fast, and easy to put up, sole trader. Okay? But if you want a separation of your assets, okay, against you and shield you against any loans that cannot be paid by the company, then create company. If you want to pool more resources, partnership. Okay, but again, that partnership will have disadvantages. So it depends on how which one you will put up. Okay. All right. Okay. I'm talking continuously. Okay. All right. So now, so you know certain concept of accounting, and hopefully you have that. And again, in recording, if you want to again go through it, you can watch the recording, not including my face. We don't have the technology. Okay. So I'm moving here and there, so hopefully they will have that AI camera. All right. So let's talk about the first financial statement, balance sheet. Now, so uh, don't panic when I talk about accounting terms. Don't worry. These are just creation of accountants standards, accounting standards. So to scare people, it's, it's not really it's not really a fancy word, but if you notice, you already have it. We only put it in wordings in a way to make it formal and understand and create like a single language that we can talk as an accountant. Okay, right? But it's not really that difficult. Okay, now balance sheet. Balance sheet will, or the report itself will include the asset that you use for business. Take note, I'm using technical word. Use for business, and the loans you obtain or any liabilities that you incurred to run your business. And part of that will show how much you own or how much the shareholders owns. Okay, so three things I mentioned: assets or resources used, payables or liabilities that you incurred in operating the business, and part of that will be the report showing how much the owners own the business, okay, against the asset. Okay. Already, I mentioned, okay, 1, 2, 3. Assets, liabilities, equity. Okay. So in accounting, that is a main focus of the what we call accounting equation. I'm really sorry, I don't have the marker here, but anyway, later I'll show. So asset owns or controls, liabilities, entity owes on a particular date, and then equity or internal owner's claim over the asset. Simple. Okay, so when you heard balance sheet, okay, so this is the asset that the company use or own, and this is the amount that they incurred on the period, and then it's the part of how much they can claim over the asset. As simple as that. Okay. All right. So the hardest formula ever created in accounting profession, and you make it balance. Okay. Huh? What? Wait. Again, don't worry. In this unit, we will not do so much of journal entries. I may use journal entries just to illustrate, but we will not do so much journal entries here. Okay. Maybe just for illustration. Now, assets, you see here. So the total assets you own and use in operation. And then total liabilities here. You get the difference? That will be the same with equity. So that's why we call it balance. It should be equal. Okay. So when you're facing here, left side, they will say left side. Okay, that will be on the debit side. Okay. And the right side will be on the credit side. Okay. Clear? Right. Remember, right? Left, debit, credit. Okay. No, don't dance, okay? So easy? Okay, but again, the main aim of this unit is not to ask you so much on journal entries because that is not part of the curriculum, but for you to understand how accounting works. Now, asset, as per the standards in accounting standard, it says present economic resource controlled by the entity. Take note. That's why I use the word resource control or use. Why? Because in accounting, we are now for particularly on management students or business management students. Take note. When accountant is showing to you the balance sheet and they're talking about assets, they're not talking about only about what the company owns. They're talking about the resources that the company is currently using. Take note that this is technical. Okay? Why? Because in the balance sheet, you might be questioning, hey, why are you reporting this? You're not owning this asset. In accounting, as long as you are the one using, you need to report that as part of the balance sheet. Here, like for example, there is a lease agreement, long-term lease. Okay? The ownership will only transfer to you at the end of the lease, which is let's say 10 years. On the third year, you're still using the asset. Question, do you own the asset? Answer, no. But are you the one primarily benefiting over that asset because of the lease agreement? Yes. Report it as asset. Clear? So, in the future, if you read financial statements and they're talking about balance sheet, it's not primarily talking about a particular asset, the amount that they own. That will also include in there, but the asset that they are currently using for their operation. Clear? Am I clear? Future business managers and accountants? Yes? Okay. Maybe. Okay. Anyway. As a result of past event, which means it's not an asset if you haven't acquired it or there is no transaction. For example, I will report Prado in my balance sheet. And then you will ask, Mister, do you own it? No. Are you currently using it? No. No. Is it under the lease? No. And then what you're talking about, you put it in as part of your balance sheet. I just thought about it. No. Past event. There should be a transaction first before you record that as part of your asset. Clear? So you will not say, I have the asset. Okay, I have this huge property. I'll report it as part of my balance sheet. And then someone will ask, how come? No, in the future I will have it. Positive thinking. Yes, I will have it. Yes. I know positive thinking usually works, but now is it a part of your balance sheet? No. You own it? No. You use it? Are you currently using it? No. Is it under the agreement? No. Don't report it as asset. That's what we call determining the past events. Okay, clear? Okay. So clear on that part. And then it says, from which future economic benefits. What does it mean? If that resources cannot provide you with, or possibly cannot provide you with future economic benefits, don't report it as asset. Okay, example. I acquired this laptop. Even if I don't use it, will that provide me with benefits in the future? If I'm not using it now, maybe in the future, will that benefit me? Yes or no? Yes. Okay, switch it on, install Netflix and watch. No. Not allowed here. This IPS laptop. But anyway, will that benefit you in the future? Yes. When you purchase a mobile phone, why are you purchasing mobile phone? You got lots of money, you don't know where to put it, and then you just purchase a mobile phone. Huh? No. Even if you do that, I still have argument. You got lots of money. You purchase it because to satisfy something, which means you benefited from it, right? Got it? Okay. So purchase something, you will benefit or have benefited from that. That's an asset. Okay. That's why accountants are really good at these things, purchasing money and these things, because before they purchase something, they will ask this: will that benefit us? Accountants are really good at this because one of the questions that they will ask: if I purchase this, will this benefit me? Okay, future managers also, before you purchase an item, try to determine, if I purchase a new car, okay, will this benefit us, or it will just add up to lots of cars that we already have? Okay. How many cars you have? Anyway, so you have to determine. Okay. So am I clear? Economic resource, result of past events, and it was what? Or it will provide you with future economic benefits. Simple as that. Okay. Now, how about liability? Liability, it says present obligation of the entity to transfer an economic resources. It means that I'm obliged currently and I need to give up economic resource. What is economic resource? Example is an asset. Like if I owe something to you, okay, 5,000 kina. Now I owe you 5,000 kina. How to settle it? I need to pay equivalent 5,000 kina, right? Cash, or maybe if you want an item, maybe let us say complete set of computer, then I'll pay. Take note, it's a present obligation, which means I owe it. I need to settle it using what? Economic resource. Okay. Now IBS. Okay. They have seen me working here really hard. Okay, and doing my job well inside the classroom. Okay. So I've done my work. So IBS is what? Obliged to pay me my salary, right? Okay. So how to settle the gap? They will pay me the salary. Okay, clear? Right. What it says, as a result of past event. So if I have done my work, that's past event. You got it? Clear. So if I've done my work, it's past event. So IBS needs to pay me. There is no obligation if you haven't what? There is no related past events. Then I will tell my boss, you need to pay me. Okay. Fine. From 10th March till 31st, you need to pay my salary. And then boss will ask, why? No, boss. That's your obligation. 10th will be tomorrow. You haven't performed it yet. So how can IBS will be what? Liable to pay you. You need to perform that one first. That is what we call past event. Another example. If the company purchase an item, okay, let us say to BNBM or Brian Bell, okay, set of computers or furnitures or appliances. They purchase it, and then uh, BNBM and Brian will usually they bill at the end. Okay, they usually bill the company at the end of the month. Now, if we purchase it already, then at the end of the month, is that purchase or the transaction purchase is a past event? Yes, at the end of the month, it's already a past event, right? Are we obliged to pay it? Yes. Why? You purchase it now, 9th March, 31st March, you need to pay, right? Because usually they will bill at the end of the month. And then do we need to settle it using money or economic resource? Yes. So that is liability. Very clear? There's no such thing as you need to pay me because I'm a really great lecturer. Okay, I will perform my work in the future. Possible? No, I need to perform first. Past event. Very clear? Oh, okay. Now equity is quite quite funny. In the standards, in accounting standards, in international financial reporting standards, it's not defined in detail. The definition is only like this. A residual interest in the asset of the entity after deducting all liabilities. That's it. I think those who are writing standards got lazy. Okay, so, how to define this? Leave it. Just asset less liabilities. That's it. Okay. That's how you can see it. You try to search it. It's the same definition that provided there. Okay. I don't know, for some reason they got lazy on writing. It is a detailed definition. Okay. So are we clear on assets, liabilities, and equity? Equity is just difference between asset and liabilities. That's it. Okay, clear? Right. So, but basically, equity section includes the amount contributed by the owners plus any accumulated profits. Now, I'll discuss that one because it's important for you in the future. When I talk about accumulated profits, the company normally will earn income and they are required to share that income to the owners. Remember, a separate entity, owners and the business or the company. So the company needs to pay or to distribute the income, clear, to the owners. But normally they will not give all the income. They will accumulate certain portion of the profits, probably just to show that in the future we are willing or we still have enough profit to sustain our business. Clear? So the sharing of income or the sharing income, we call it dividends. So if you are a shareholder, you will receive what we call dividends. Okay? Dividends from the company. And part of that will be accumulated. We call it retained earnings. Okay, clear, huh? Easy to remember. Retained earnings is the residual income after deducting the dividend. Okay, or distributing the dividend. Okay. Dividend is the share of income, okay, given to the shareholders or the owners. Easy to remember? All right, so there's an illustration here. All right, assets and liabilities, present economic resource, present obligation. Then in the other definition, it says control. And control is important. If you have the control over the asset, which means you are benefiting from that asset, okay, comparing with the real owner, then you are the one with the control. And you need to report it as part of your assets. Here, transfer economic resource, so that's a requirement. And both of them are past events. Because anyway, accounting, right? Remember, historical past events. So that's their purpose. All right, recognition consideration, uncertainty of existence, probability of an inflow. So which means we need to know first whether there will be economic inflow or outflow for that asset, and uncertainty of measurement because as accountants you will use different measurements. Okay. And in liability disclosure in the notes accounts is always an option. Now another concept, we're almost done, is what we call current and non-current assets and liabilities. Simple, huh? In current and non-current assets and liabilities, the distinction is on timing. What is the timing? Okay. Now, for you to enable to understand timing, uh, for example, an asset, if the asset can be consumed within a year, we classify that as current current asset, which means within 12 months you can consume it. So okay, current asset. If a liability is payable within a year, then current liabilities. Okay, so it depends on the timing. Normally, but there are so many restrictions about it. Did we mention it here? Anyway, so as a general rule, within 12 months, if you can consume an asset within 12 months, current asset. If you will be required to pay a liability within 12 months, then current liabilities. Clear? Other than that, non-current. So if an asset can be consumed for more than a year, non-current asset. For example, this projector. Okay, we acquired this in 2021, I would say, or 2022. So that asset can be considered as non-current because we have been able to use it for more than a year. Okay? How about cash? If you have cash, 100 in, not even 1 day. Okay? I will use it. So cash is what? Current asset. Clear? So easy to determine current, non-current because accountants will prepare a report in that way. So managers, current asset that can be consumed within 12 months, non-current asset, those which can be used for more than 12 months. AC, this one we acquired in 2024, so not 2026, still working, right? 2024 or 2025, I don't know. Anyway, this laptop we acquired 3 years ago, so still working, so non-current asset. So there are examples here: assets, okay, trade receivables, debtors, inventories or stocks, financial asset, property, plant, equipment, goodwill, tangible assets. These are examples of assets. And then liabilities, trade and accounts payable or creditors, if you're familiar with that term. Okay. Borrowings, tax liabilities, provisions, financial liabilities, and secured debts. In equity, that will include share capital, that is the contribution or the funds given by the owner or the shareholders. Retained earnings, I already given you an example. That is the part of the profit which has been retained or accumulated by the company after deducting the dividends. And reserves will be a generic term that the company can use for different purposes. That one I will not discuss further here because it will just complicate. But anyway, reserve is just a particular special purpose item under equity that will be used to address different issues. For example, if they want to build a new plant, then they will create a reserve account, just showing that they are reserving this amount for future plan. Okay, not an actual money, but just showing that there is a particular portion of the profits designated for continuous plant expansion or creation. Okay, clear? So that's an example of reserves. But am I clear on at least the basic share capital? That's the contribution of the owner or the shareholders. Retained earnings, that will be what? The profits retained or accumulated by the company after deducting dividends. Clear? Okay, this one is just for discussion. Okay, my session ends after this. Okay, no more. Okay, no more. All right, so my session ends. I'll end the recording.